Chapter 1. The $12 billion Mirage. Picture this: a coffee company that didn't exist 3 years ago suddenly becomes more valuable than American Airlines, Marriott Hotels, and Target combined. That's the insane reality of Luckin Coffee in January 2020, when its stock peaked at $51 per share, crowning it with a jaw-dropping $12 billion valuation. Wall Street's smartest money managers, BlackRock, Morgan Stanley, Goldman Sachs, were falling over themselves to invest in what looked like China's next mega success story. There was just one tiny problem: nearly $500 million in sales never actually happened. Welcome to one of the most audacious frauds in modern financial history, where a Chinese startup fooled the world's most sophisticated investors, fabricated over $300 million in transactions, and crashed so spectacularly that it rewrote the rules for Chinese companies listing in America. This is the story of Luckin Coffee, the fake Starbucks that brewed up a scandal Wall Street will never forget. Chapter 2. Lightning in a Cup. Jenny Jiaqian and billionaire Charles Zhengyao Lu launched Luckin Coffee in October 2017, with a vision so ambitious it bordered on delusional: overtake Starbucks in the world's most populous country. But here's where it gets interesting. These weren't wide-eyed dreamers starting from scratch. Lu was a serial entrepreneur famous for his growth above all costs philosophy at his previous ventures, the car rental firm Car Inc. and ride-hailing company UCar. Qian had been his right-hand executive at both companies, absorbing his relentless expansion mentality like a sponge. Their strategy was brilliantly simple and devastatingly expensive: flood China's cities with small, app-based coffee shops that prioritize delivery and pickup over the traditional cafe experience. Forget the cozy ambience Starbucks spent decades cultivating. Luckin's stores were sleek, minimalist, and optimized purely for speed and volume. Customers ordered exclusively through a mobile app, received aggressive discounts, sometimes up to 89% off, and often got their first cup completely free. The expansion was nothing short of breathtaking. Luckin opened over 2,000 stores in its first year alone, averaging an insane 5.2 new locations every single day. By the end of 2019, just 26 months after opening its first Beijing location, Luckin operated 4,500 stores across China, more than Starbucks had managed to open in 2 decades of operating in the country. They served 40 million customers and poured 111 million cups of coffee. The company was burning through cash like it was going out of style, hemorrhaging billions of yuan. But investors didn't care. They saw hockey stick growth charts and a founder team with a proven track record. Chapter 3. Wall Street gets caffeinated. Here's where the American investor FOMO kicked into overdrive. In November 2018, Luckin raised $200 million at a $2.2 billion valuation. Just 5 months later, in April 2019, BlackRock, the world's largest asset manager controlling trillions in assets, led another funding round, pouring in $150 million and pushing Luckin's valuation to $2.9 billion. Singapore's sovereign wealth fund, GIC, joined in. So did China International Capital Corporation. The smart money was stampeding into Luckin, convinced they'd discovered the next Alibaba. But the real validation came on May 17, 2019, when Luckin went public on NASDAQ in one of the most hyped IPOs of the year. The company raised $651 million, pricing shares at $17 and achieving a market value exceeding $5 billion. For a company that was barely 18 months old, this was astronomical. Investment banks, Credit Suisse, Morgan Stanley, and Goldman Sachs all clamored to underwrite the deal. Analysts published glowing research reports. The narrative was irresistible: a tech-savvy Chinese challenger using mobile apps and data analytics to disrupt the world's biggest coffee chain in the world's biggest market. The stock kept climbing. By the third quarter of 2019, shares had surged 60% above the IPO price. By the fourth quarter, they doubled. In January 2020, Luckin hit its all-time high of $51 per share, 3 times its IPO price achieved in just 8 months. The market cap topped $12 to $13 billion, depending on whose calculations you believed. Charles Lu's stake was worth $2.9 billion, making him a multi-billionaire on paper. Jenny Chen's 15% ownership was valued at $1.1 billion. And here's the kicker. Just 2 days before the stock peaked, Luckin had successfully raised another $400 million through convertible bonds, with Credit Suisse and Morgan Stanley again serving as underwriters. Chapter 4. The Anonymous Bombshell. But someone wasn't buying the hype. On January 31st, 2020, notorious short seller Carson Block and his firm Muddy Waters Research dropped an 89-page report on Twitter that would eventually topple the entire house of cards. The twist? Muddy Waters hadn't written the report themselves. They'd received it anonymously and found it credible enough to share publicly. The document was devastating in its forensic detail. An anonymous team had conducted a months-long investigation involving video surveillance of Luckin stores, collecting thousands of receipts and meticulously analyzing order patterns. Their findings were explosive. Luckin was inflating the number of items sold per store by at least 69% in the third quarter of 2019 and a staggering 88% in the fourth quarter. The investigation had captured 11,200 hours of video footage showing actual customer traffic dramatically lower than reported sales figures. The report revealed clever fraud mechanics. Luckin's point-of-sale system generated sequential order numbers, so the 300th order of the day would receive a receipt marked 300. But investigators noticed something bizarre. The order numbers didn't match the actual volume of customers walking through the doors. Luckin was deliberately skipping order numbers, jumping from order 50 to order 200, for example, to create the illusion of higher sales volumes. They'd even found internal communications showing company executives explicitly telling store employees to ignore these discrepancies. Beyond volume manipulation, Luckin was also inflating average selling prices by at least 12.3%. This they had to do because the company had proudly announced achieving store-level profitability in 2019, meaning individual locations were supposedly generating more revenue than their operating costs. To support that claim while maintaining their aggressive discount strategy, they needed to show higher prices than customers were actually paying. Luckin's initial response was defiant. On February 3, 2020, the company issued a statement categorically denying all allegations, calling the report's methodology flawed, the evidence unsubstantiated, and the allegations unsupported speculations and malicious interpretations. CFO Reinhard Schakel even told bondholders in early February that the anonymous report was fabricated and that Luckin's own data contradicted its claims. The stock wobbled but didn't collapse. Many investors chose to believe the company over the anonymous accusers. Chapter 5. The House of Cards collapses. They shouldn't have. Behind the scenes, Luckin's external auditor Ernst & Young had begun asking uncomfortable questions. The audit committee initiated an internal investigation, and on April 2, 2020, exactly 2 months after dismissing the allegations, Luckin Coffee dropped a regulatory bombshell that sent shockwaves through global markets. In a filing to the Securities and Exchange Commission, the company admitted that Chief Operating Officer Liu Jian and several of his subordinates had engaged in serious misconduct, fabricating transactions worth approximately 2.2 billion yuan, around $310 million from the second quarter through the fourth quarter of 2019. The admission was stunning in its bluntness. Everything the anonymous report had alleged was essentially true. Luckin's meteoric rise had been built on fabricated sales. The stock market's reaction was immediate and brutal. Shares plummeted 80% before trading was suspended on April 7th. Investors who bought into the growth story watched billions evaporate overnight. The $400 million convertible bonds issued just 2 months earlier, which had traded near par value, collapsed to 10 cents on the dollar. Charles Liu, who had borrowed $518 million, using his Luckin shares as collateral, defaulted on the margin loan as his collateral became essentially worthless. Chapter 6. Anatomy of the Fraud. The internal investigation, conducted by law firm Kirkland & Ellis and consultancy FTI Consulting, eventually revealed the full scope of the deception. From April 2019, just 1 month before the company's IPO, through January 2020, Luckin executives had orchestrated 3 interconnected fraud schemes specifically designed to inflate revenue and achieve the growth targets investors expected. Scheme 1 was relatively small scale. Luckin employees used their own money to purchase coupons through the app, then redeemed those coupons to create fake orders. This accounted for over $1 million in fabricated sales. Scheme 2 expanded the playbook. Starting in May 2019, employees created fake corporate customer accounts controlled by people related to Luckin staff. These phantom companies would transfer money to buy coupons, which were then redeemed to generate bogus transactions totaling roughly $10 million. But Scheme 3 was the real masterpiece of fraud, accounting for approximately 90% of the total, around $280 million. Luckin employees or their associates established shell companies that appeared to be third-party coupon resellers. These shells would transfer funds to Luckin to purchase bulk coupons. Then employees would literally alter the bank statements, changing the sender's name from the actual funding source to the shell company name to make everything appear legitimate. The coupons would be redeemed through completely fabricated orders. No real customers, no real coffee, just phantom transactions flowing through the system to generate revenue recognition. To make the fraud less obvious, Luckin also fabricated costs and expenses totaling between $190 and $196 million. They created fake supplier relationships, making payments to vendors that provided absolutely no goods or services in return. One employee even expressed concern in internal communications that the fraud would be exposed if real suppliers noticed the abnormality in Luckin's growth because we don't purchase that much. The conspirators literally created a fake operations database to track the fraudulent transactions separately from real business and systematically altered accounting records and bank statements to conceal the scheme. Chapter 7. The Reckoning. The fallout was swift and merciless. On May 12, 2020, Luckin's board terminated both CEO Jenny Chen and COO Liu Jian, demanding their resignations from the board. 6 other employees who either participated in or knew about the fraud were suspended or placed on leave. Jinyi Guo, a longtime lieutenant of Charles Liu, who'd served as senior vice president of supply chain, was appointed acting CEO. In July, even Liu himself was pushed out as chairman as the company desperately tried to distance itself from the scandal. Nasdaq moved quickly. On May 19, 2020, the exchange notified Luckin of its intention to delist the company, citing public interest concerns raised by the fabricated transactions. Luckin briefly considered appealing, but ultimately withdrew its request. On June 29, 2020, just 13 months after its triumphant IPO, Luckin Coffee was officially delisted from the Nasdaq exchange. The company that had once been valued at $12 billion was now worth less than $1 billion. The regulatory penalties came in waves. In September 2020, China's State Administration for Market Regulation concluded its investigation and fined Luckin's 2 main operating entities, plus 43 accomplice companies, a combined total of 61 million yuan, approximately $9 million. While this seems like a slap on the wrist compared to the scale of fraud, it represented the maximum penalty available under Chinese anti-unfair competition law at the time. The US Securities and Exchange Commission hit far harder. On December 16, 2020, the SEC charged Luckin with materially misstating its revenue by approximately 28% for the second quarter of 2019 and 45% for the third quarter. During those same periods, the company had understated its net operating loss by about 15% and 34% respectively. The company agreed to pay a $180 million penalty to settle the charges without admitting or denying the allegations. The SEC explicitly noted that the settlement could be offset by payments to defrauded security holders, essentially making Luckin's creditors and shareholders stand first in line for any recovery. By February 2021, the company filed for Chapter 15 bankruptcy protection in the United States, a special proceeding that allows foreign companies to shield themselves from US creditors while undergoing restructuring proceedings in their home country. By this point, Luckin had become a cautionary tale taught in business schools. A punchline in financial circles, and a diplomatic flashpoint between US and Chinese regulators. Chapter 8. The Perfect Storm. So how did this happen? How did a fraud of this magnitude fool some of the world's most sophisticated investors and auditors? The answer lies in a perfect storm of cultural pressures, investor psychology, and systemic vulnerabilities. First, the growth at all costs mentality that dominates Chinese tech startups created enormous pressure to deliver exponential expansion. Charles Liu had built his reputation on aggressive growth at Car Inc. and UCAR, and he brought that same philosophy to Luckin with disastrous results. When organic growth couldn't keep pace with the ambitious targets Liu and Qian had set, the temptation to fabricate numbers became irresistible. Second, American investor FOMO was operating at full throttle. After watching Alibaba, Tencent, and other Chinese tech giants generate extraordinary returns, US investors were desperate not to miss the next big thing. When Luckin presented a compelling narrative, mobile-first disruption of an enormous traditional market, investors wanted to believe it so badly that they overlooked red flags. The company was burning cash at an unsustainable rate, had never turned a profit, and was operating in a market where free coffee and 89% discounts had trained customers to have zero brand loyalty. But none of that mattered when the growth charts looked good. Third, cross-border listing rules created accountability gaps that the fraudsters exploited. Luckin was incorporated in the Cayman Islands, operated in China, and listed in the United States. This structure made it difficult for any single regulator to have complete oversight. Chinese authorities couldn't fully examine a Cayman entity. US regulators couldn't easily access documents and personnel in China. The Public Company Accounting Oversight Board, which oversees auditors of US-listed companies, wasn't allowed to inspect audit work papers in China due to Chinese secrecy laws. Luckin's fraud succeeded partly because it operated in the regulatory cracks between two superpowers. Chapter 9. The Legacy. The Luckin Coffee scandal fundamentally changed how Chinese companies access American capital markets. The fraud helped accelerate passage of the 2020 Holding Foreign Companies Accountable Act, which passed both houses of Congress unanimously. The law requires foreign companies to allow the PCAOB to inspect their audit work papers or face delisting after 3 consecutive years of non-compliance. Over 200 Chinese companies trading in the US potentially face delisting if China doesn't grant access. And the Luckin scandal was the catalyst that made this hardline approach politically possible. For the individuals involved, the consequences were severe. Jenny Qian and Liu Jian were fired, stripped of their board seats, and became the focus of multiple investigations. Charles Liu saw his net worth crater from nearly $3 billion to about $500 million as his Luckin stake became virtually worthless and his margin loans went into default. Civil lawsuits from defrauded bondholders and shareholders piled up, seeking hundreds of millions in damages. While reports mentioned Chinese regulatory penalties and lifetime securities market bans were imposed, specific details about individual executive bans remain less publicly documented than the corporate fines. The corrected numbers told the real story of Luckin's business. When the fabricated sales and expenses were removed, the store-level operating margins that executives had proudly claimed as proof of a sustainable business model essentially evaporated. The inflated pricing and phantom volumes had masked the reality that most locations were operating at a loss, unable to generate enough revenue to cover costs without the accounting tricks. Epilogue: brewing a second chance. In one of the strangest twists in corporate history, Luckin Coffee didn't actually die. After completing its bankruptcy restructuring and settling the major lawsuits, the company emerged in 2022 under new ownership, led by Beijing private equity firm Centurium Capital. The new management team implemented dramatic cost cuts, raised prices to sustainable levels, eliminated the free coffee promotions that had attracted only deal seekers, and shifted to a franchise model that required less capital. They closed underperforming stores, slashed advertising budgets by 70%, and focused relentlessly on unit economics rather than vanity growth metrics. By 2023, Luckin had not only survived, but was actually thriving domestically, surpassing Starbucks in China revenue and expanding to over 29,000 stores. The company was reportedly exploring a potential relisting, contemplating a return to the very capital markets it had so spectacularly defrauded just years earlier. Whether American investors will give Luckin a second chance remains to be seen, but the resurrection represents one of the most improbable comebacks in business history. The lesson: in the intoxicating world of high-growth investing, sometimes the coffee isn't the only thing that's fake. And when Wall Street's FOMO collides with a growth at all costs startup culture, even the smartest money in the world can get burned.